Welcome all to the Node. I am Mike, aka Veteran Crypto, and this is your place for news, interviews, and DeFi and crypto education. So, with that, David will be joining us here shortly. But until he does, we have some exciting news. Over the weekend, we were able to lock in with Canton News and the Canton Army. And moving forward, we're going to be the official hosts of their spaces on X. And so, starting this Thursday, we're going to be doing an interview. David will be heading up the interview with Cashin and the CEO of Cashin on the Canton Network. In alignment with our ethos, we are not accepting any payment whatsoever for doing this. We are just, as always, very interested in crypto and DeFi and these projects, and we just want to bring value to the community. So, David, how's it going, brother?
Doing well, Mike. Doing really well. Just taking a look at markets on this beautiful Monday morning, August 3rd. We've had some thunderstorms here in St. Pete Beach over the last couple of days. Man, watching all of this just, sky water fall out of the sky. I'm just adjusting my light. Watching all of this rain, man, it's nothing like I've ever seen in my life because I'm from California, so to see all of this rain on the beach, man, it is so cool. It is so cool. But we've got some big developments in markets today with everything going on with, Cold Card, everything going on with Strategy and Sailor authorizing the sale of $5 billion, selling some Bitcoin this morning. And the S&P, man, ripping, almost printing some fresh all-time highs. And then if you take a look at some of these tech stocks, oh my goodness, they have had one hell of a morning, with Google plus 5%, Amazon plus 5%, Meta plus 6.33%, Microsoft plus 4.7%, even Oracle participating in the rally plus 6%. And then you've got NVIDIA plus 3%. Importantly, Apple not participating in the rally this morning, but man, big moves. And that's as you see bonds and notes trading higher. So equity.
Didn't Apple not get as big of a pullback as the rest of them? Was it Apple that I'm thinking of?
Yes. So Apple actually printed fresh all-time highs as the rest of the space was selling off a little bit.
So it was Apple.
It was.
It's not going to, it doesn't need to either, participate in the rebound if it didn't lose, like the others did.
Yeah, and Apple just reported. So Apple reported earnings last Thursday. They beat, and they actually got hurt after reporting. So a little bit of a gap down after reporting earnings last Thursday. But it's just been so interesting to see these big tech names as they continue to just pour all of their free cash flow into AI CapEx. And yet it seems as though they're getting rewarded for that now. The word on the street was that if they did not start to curtail that CapEx, then they would not get rewarded. But we're seeing the exact opposite. And it's just so interesting to me that there are a lot of signals that are flashing on my screen this morning that are maybe contrarian. You see yields in Japan.
Go ahead and share your screen for a little bit. We'll get in some charts for a minute here.
Sure. Let me go ahead and share my screen, and let's run through markets. Let's take a look. Let's see what's going on. So I want to start things off. I just want to make sure that everyone can see this clearly. So I'm going to zoom out from a daily to a weekly. And so these are yields in Japan. This is the long bond in Japan, the Japanese 30-year bond. And this is what you call blowing out. So yields in Japan have blown out, man. Kind of like those people who were eating Taco Bell, like the Taco Bell salads.
It was the lettuce. It was
the lettuce. Yeah. And so just like those people who blew out off of those Taco Bell salads, we're seeing yields in Japan just rip. And, there's no end in sight to this because, as Lynn Alden likes to say, nothing stops this train. She's absolutely right. What the Japanese have been engaged in for the last 3 or 4 decades is exactly what we have started to engage in the United States since 2008, basically. So this is something that I am watching quite closely. I'm also watching USD JPY. So there has been a lot of intervention in this market as of late, basically like the last week and a half, where the word on the street, man, is that the Bank of Japan has spent like $100 billion over the last just couple of days to sell treasuries, raise dollars, and use those dollars to buy yen to support the yen. Because remember,
the Japanese are a big buyer of our of U.S. treasuries. So,
well, they've started to become a seller, and so that's why, yeah. So I want to just share something with everyone. If you zoom out from a weekly to a monthly here, so this is a monthly chart, and these data go all the way back to like the 1970s, like 1971. So if we just zoom in on this a little bit, notice this level of what was resistance back in 1990. We're talking about in April of 1990. I know, right? This is a long time ago. I was a baby, a little baby. So, back then,
right? I was graduating high school.
Yeah, man. So if you take a look back in 1990, the yen got rejected at 162. Now, formed this massive basing pattern, big base. And just last week, where did the yen break out above 162? That level of resistance got broken last week. Let's zoom in here. So notice here, this is back in May and June of 2024. The yen got up to 162, and what happened? Well, over the ensuing 2 weeks, or 2 months, 2.5 months. So this is a monthly. So when the yen got up to 162 back in June of 2024, well, there was intervention. The Bank of Japan, and I'm assuming the Fed also, that was under the leadership of then Fed Chair Powell, the yen actually fell and strengthened from 162 to 139. Now, what are we seeing so far over the last week and a half? Well, we got the breakout. And this is a breakout that I was waiting for a long time to be able to eventually get short the yen again. Because here's the thing, Mike, there is no participant, no single participant is bigger than the market. Even a big central bank, they are not bigger than the market. The market is bigger than any one single participant. So when you see this breakout above 162 and the correction, the pullback, this is when you see the pullback here, that's the yen strengthening in US dollar terms. When you see this chart go up, that's the yen weakening in US dollar terms. Now, if we just zoom out on this chart a little bit and we just take a look at this, now that 162 has broken to the upside, it doesn't matter how much more the Bank of Japan and the Fed and the Treasury, the US Treasury, continue to intervene in this market. I think eventually this pushes sharply higher, because what the Japanese are doing is printing to give their population goodies, free stuff, and printing in order they're going to rearm. That's what they're doing. They're rearming and they're giving away free stuff. And so they're doing that when the Bank of Japan owns like 55% of the Japanese bond market and a big portion of their equities market too. So I think that this has only one direction to go over the next, maybe 12 or 24 months, and that is straight up. I think 200 is, in the not too distant future here for the yen. So yeah, that's going to be extremely important to watch. But the interest rate
up on this chart isn't a good thing, right?
No, it's not a good thing. And what it also means is the Bank of Japan is going to have to raise rates. So last week, they held off on raising rates. It was a hawkish pause, I guess you could say. And so take a look at, again, this is the yield on the long bond in Japan. This is a monthly. So this is called a parabola. it's just running straight up because there's no other direction for it to go. And so when you see The Japanese 30-year sitting at 3.98%. But then you take a look at the US 30-year sitting at 5.22% today. Well, if the Japanese 30-year, and we should probably take a look at the 10-year, but we can take a look at the long bond here. If the Japanese 30-year starts to get closer to the US 30-year, if that yield differential compresses, then anyone who's still running that carry trade is going to have to unwind it. So I think that this is definitely something that we need to continue to watch. I want to zoom in here to a weekly, and let's take a look at equities just real quick, the S&P and the NASDAQ. Take a look at the performance of the S&P. Just unbelievable. We got a false breakdown. If we zoom in from the weekly to the daily here, we got that false breakdown last week at the end of July, just briefly breaking down below this level of trend line support. And now we're getting another, it's gappy. We're getting these gaps. So here's a gap on the way up. And this is looking really bullish for the S&P right here. We've got this level of resistance that I can just go ahead and draw in, this horizontal. We get above 76.51, and I think the S&P, man, could rally to 8,000. So this is a midterm year. Very interesting to see the S&P rallying sharply in a midterm year. It makes me think that there could be some type of coordinated intervention by the Fed. It looks like the Fed is buying treasuries hand over fist again. And then when I take a look at these big tech names, Google, Amazon, Meta, Microsoft, Apple, Nvidia, Tesla, SpaceX, these big tech names, I'm starting to think, Mike, that a lot of their earnings, maybe fake is the wrong word. But if you dig into the Google,
I'd say manipulated.
I think that there's some type of accounting shenanigans going on, because when you take a look at Google's,
wasn't there a bunch of pretty credible news that they were basically doing this incestuous, borrowing from each other and putting in like buy orders and
that's exactly what's happening.
Artificially inflating each other.
Yeah, and then the pin that could pop that is OpenAI and Anthropic. Like, if those companies ever big problem for the market, because those companies, if we bring it on over here to our community, I was posting about this all morning. So if we take a look here, there's a bunch of stuff in here on, Oracle CDS is blowing out. So credit default swaps for Oracle blowing out to the upside. And all that means is the cost to insure Oracle bonds has blown out to the upside. Now, if we take a look at, there were a couple of items here. August for Bitcoin in a midterm year has never been an up month, never. So will this time be different? I don't think so. Let me see if I can zoom in here even a little bit further so we can see this. August 2014, down sharply for Bitcoin. August 2018, down sharply for Bitcoin. August 2022, down sharply for Bitcoin. So that's definitely something that we need to watch. So AI CapEx, right? AI CapEx. We got an ISM print.
Hey, David, real quick, can you hear me okay?
Yeah, I can hear you just fine.
All right.
So, we're taking a look here. This post was interesting. This is, market respondents. The people who respond to that ISM, that's a manufacturing survey. So that manufacturing survey came in a little bit better than expected today. That's great, right? What is driving that manufacturing survey? What's driving it higher? Well, I think it's the AI CapEx. All of those big tech companies, the spending that they're engaged in to build these data centers out right now is just so massive. It's unprecedented. So if those tech companies, are the driver of the expansion in manufacturing in the United States, well, what happens if they ever curtail some of that spending? Just something to think about. So let's take a look at, there was so much going on with Cold Card,
there's a lot of and it not just for Cold Card, just hardware wallets in general. It has a lot of people doubting the security of self custody in cold storage after what happened.
Oh man, it was horrible what happened. Now, I've been reading, and I got a post. There's a bunch of posts that I've been, putting in our community. So for anyone who wants to join our free community at thenode.pro, we've got our Telegram, we've got our Discord, but the best community is right there on our website. Totally free. So totally free to join. Hop in here, get the intel that we post every single day. This is a great place to get a ton of free information. And the thing with that cold card exploit is, a lot of times, Mike, because we've gone through so many pieces of deep dive research on these protocols, whenever you see an exploit, the first thing that I want to point to is the team. It's like you got to look at the insiders first. So I have a really hard time believing that the cold card team didn't pass statistics 101. Like, what? You want me to believe that they didn't pass basic statistics in college? Really? Like, they couldn't figure out how to make their entropy safe enough? Like, no way. There's no way. And it looks like the first version of the firmware on those cold card devices was a Trezor version. Like, it was a Trezor fork or something. And then when they, quote, upgraded that firmware to their, like, obviously unsafe version, apparently, I've been starting to read that apparently there were users of cold card devices that were getting drained years ago, instantly, upon depositing funds onto their cold card wallets. And yet, when those users reported this, they got blocked and banned by the cold card team. So I'm like, wait, hold on a second.
Really?
Yeah.
And we have a source, like a cited source for that?
I posted it here in the community. It's from X. So yeah, so dude, it's just like, this is like really, really, if true, really bad. Because I'm just thinking to myself, Mike, like, who's the sheriff in town for this stuff? Like, if you get assets stolen from you in crypto and DeFi, who do you go to? Like, the FBI doesn't help you unless it reaches some threshold. I think it's got to be like $4 million or greater for the FBI to help you. And so what, you're going to go to your local sheriff? Like, how is that going to happen? Like, there's no one to help you. So like, it's 93,000 cold card generated seeds, seem to be like, it looks like the entire cold card device is just totally screwed, man. So yeah, this is one of the posts that I posted about.
I clicked through because, I mean, here at the Node, we're very big on citing sources. So I want to make sure people understand this is the source, so we need to, look deeper into this, because that's pretty sketchy if true. So, if 93,000 seeds were generated via cold card, there's a 50% chance two people would generate the same 24-word seed phrase or wallet. With proper entropy, a 24-word seed phrase has 256 bits of randomness. Bunch of math, that's 400 undecillion wallets. So a lot. If all 8 billion humans generated a billion seeds per second, it would take about 1.6 trillion years to reach 50% collision odds.
Right, but Mike, that's if they had used proper entropy math. They didn't.
Yes.
So it's like, and apparently, and this is a rumor as of right now. I can't verify this, or have not been able to verify this yet. But the rumor is that this cold card team knew about this 4 years ago. Like, that's a problem, man.
Now,
if true.
If true, like I said, I would really like to see if we can find some information on, if that's true, because that's pretty damning if it is.
Yeah, I mean, no kidding, man. So let me see if I can find that post. It's in my X. And also, so here's something that is true. The emergency firmware like update or hotfix for cold card devices, that emergency update apparently is bricking devices. So like,
oh no,
dude, like, so imagine like, like, heaven forbid, like, funds are stolen from you. And then you're like, oh, now I've got to update this device. And then you update the firmware on the device and it turns into a brick. It's just like, what?
Dude,
It's horrible.
it is. It's insane that,
Yeah.
and it's the double-edged sword of being, this early, in a technology. A lot of people have been in a lot longer than I have. I've only been in crypto about 6 years now, but it's when you're, and we're still very early. I mean, we don't even have clarity when it comes to, regulation. Just over the past couple of years, really, have we really gotten any sort of like institutions and things like that getting involved in this technology? They just started building and launching a lot of these institutions and things like that, projects like Canton that are focused on institutions, government use cases, things like things of that nature. It's all pretty new. Up until somewhat recently, crypto was pretty much just a bunch of crypto punks looking to, kind of separate themselves from the traditional finance system and the US dollar and trash fiat, which I'm 100% for, because I mean, we've all seen, how governments have managed fiat and, inflation and, the corrupt banking system. And, we all understand, the pitfalls of that. But that being said, this technology is being adopted by institutions and governments, and with that is a double-edged sword. We get regulation, we get KYC, AML for a lot of this stuff, but it's also an influx of liquidity and investing, and potentially you can make a lot of money, and if you understand how to navigate crypto and these wallets and things like that, you can move any profits that you make from that more kind of TradFi regulated side over into DeFi, where you can get a lot more privacy, a lot more control over your liquidity, and potentially there's a lot of DeFi plays that you can do to lever up and to earn yield on your assets. Where I think a lot of this regulation that's looking to come out, their banks and institutions and governments are really looking to block us, the users, us, the citizens, from being able to earn on our money, because traditionally banks have had a monopoly on that, and with the Genius Act, we've already seen it where, I mean, I have a story that I want to get into where Circle and Tether, David said it repeatedly, by law, they are not allowed to share yield, the yield that they earn, because the Genius Act, any for every Tether or every USDC token that's issued, it has to be backed 1-to-1 with a US dollar or US dollar equivalent. So they usually buy treasuries because they can earn yield on that, and they keep that yield, and it's a huge part
not
of
just
their
not just keep it. Legally, they are not allowed to pass on that yield to us, the token holder. So, Mike, I've got something kind of interesting that I want to, and then I want to hop into what you've got for news. But I think maybe moving forward for the news section, what we could do is we could just post all of the news articles in our, the Node.pro community, and then we can just run through the news from our own community, man. That could be pretty cool. But
that sounds a lot of extra work.
Oh, it's simple. I just post it in the community every morning now. But check this out. So I don't know if you saw the picture of Chamath Palihapitiya or whatever, like the sweaters that he wears, these things. But when you increase your US dollar reserve instead of sold for a loss, right?
Yeah.
Dude, I gotta say, like, as much as I like Michael Saylor and what he's doing, dude, he and whoever he has running strategy, they are probably the worst Bitcoin traders in the history of Bitcoin trading. Like, they're able to sell at the bottom and buy at the top, sit on a massive unrealized loss. It's like, dude, So, all right, what you got though, Mike? What's going on in news for you?
All right, let's see what we got here. It looks like we have traders have 5 billion riding on the Clarity Act. Schwab says it barely moves Bitcoin. Let me know which one of these you want to dive into. It looks like we got one. You know what? Let's take a look at this one. We got Zcash, Ethereum, Aztec, Canton, and more which chain will win the privacy race? Let's see what this is all about. So let's see. Privacy is having a moment in crypto. Oh, hold on. Let me close that out. As competition heats up, the pitfalls of the technology around the quantum threat, regulatory risk, and more make the trajectory hard to predict. A counterfeit bug sat undetected in Zcash's Orchard privacy pool for years. We pointed this out the day before that all of that went public. That that we went into our deep dive. You can go through that on the Node.pro in our free Intel library. But for 4 years, and it was capable of minting an unlimited supply of untraceable coins, illustrating the risks of one of the hottest crazes in crypto. Joe Andrews, CEO of Aztec Labs, Jared Hope, founder of Logos, and Mert Mumtaz, co-founder and CEO of Helios, join Laura Shin to argue the bug is less alarming than what it reveals. So cryptographic privacy is difficult to get right, and the industry is racing to get it right anyway because institutions will not come on-chain without it. We're seeing that with the mass adoption of Canton Network.
Right.
Banks and institutions and governments do not want transparency.
Right.
Governments, they waste our tax dollars constantly, and they don't want us to see where it goes. They depend on that inefficiency to basically mismanage and redirect, our taxes, in my opinion. But banks and institutions, they don't want transparency either because they spend a lot of money developing their trading strategies and things like that, and they don't want people copy trading them. Why would you want to spend millions of dollars coming up with advanced strategies only to have somebody use AI, scan your wallets, see what you're doing, and copy trade you?
100%. You're exactly right.
So, that is why we're seeing this massive push of banks and institutions rushing into projects like Canton. That's why we're seeing this mass adoption of Canton. And it's, again, we're not trying to shill Canton. It has its issues. I'll keep pointing out that the token is still inflationary. It has a burn mint mechanism built in that if it gets to a point to where it becomes deflationary, I think it's going to be hugely bullish for the token. However, we have not gotten there yet. But regardless, you cannot ignore the adoption. You cannot ignore that it dwarfs in the top 10 of top 10 protocols that generate fees and revenue. If you combine the number 2 through number 10, they still don't equal what Canton is generating daily, monthly, annually. It
Exactly
generates
right.
$2 to $3 million right now of fees daily.
And so, Mike, you know what I'm actually reading about right now is Zcash. I'm reading about the dates around the discovery of the exploit and when we posted our deep dive research about it. So we posted our deep dive research one day before it was made publicly known that there was an exploit. But here's the interesting thing. It looks like developers for Zcash coordinated a fix and deployed the emergency patch on June 2nd. We posted our deep dive research on June 3rd, but it started to become out there in the news media on June 4th, the day after. So I guess it had already been the patch was already deployed. But here's the thing, man. If you don't know the total supply of a token, how can you value that token? You can't. It's just just trust me, bro. What's the total supply? Trust me, bro.
Not when its whole use case is basically a privacy, a privacy Bitcoin. That's really what it was. No. Because I mean, imagine if it came out that there wasn't a hard cap of 21 million Bitcoin, that it was 1 billion. What do you think that would do to the price?
Yeah. Speaking of something else that would just dump the price, I saw that the BitGo CEO today put 100 BTC in a wallet and was goading on X, Anthropic, to hack the wallet. He was like, hey, come over here and take this Bitcoin. And I think that's really, I think that's a great thing to do, because I see Anthropic and OpenAI posting on X all the time about how dangerous and advanced their models are.
Yeah.
And I think that it's just a marketing ploy, to like get people like ginned up about the amazing nature of their frontier models. And I think that they're doing that because when you take a look at the Chinese open weight models,
Yeah.
they're as good, if not better. And then you take a
Yeah.
look at some of the XAI models, they're as good, if not better. So then OpenAI and Anthropic's frontier models. And so you got to ask yourself, like, why do OpenAI and Anthropic maintain a $800 billion or $1 trillion valuation, a private valuation at that level? Why are they valued so richly when they don't generate all that much revenue? And they've got all these spending commitments that it looks like they'll never be able to meet.
Well,
And
that's what we've been pointing out about the majority of crypto projects. And this isn't FUD. I mean, this is just good investing and good business. You look at a lot of these crypto projects and they have massive market caps. You look at XRP, Cardano, pretty much anything, that's a high market cap. And if you look, they're not generating, because that's how you value a company is, how much fees and revenue does it generate each year? And that gives you an idea of how, what the company's worth. Because if nobody is buying your good or, your goods or services, and, you have no customers, you have no fees, no revenue, you're not making any money. So why would you as an investor want to invest in it?
I'll tell you, Mike, on my shopping list, over the next, let's call it like 12 to 16 weeks, I'm going to be DCAing into my favorite projects and coins. Brother, there's
so
four.
Let me guess: XRP, Cardano,
no,
Shiba Inu.
No, I can't do it. I can't do it, Captain. I can't do it. So I'm looking at a Bitcoin, Ethereum, Solana, and Tron. Ethereum, Solana, and Tron, those three, that's like the entirety of the stablecoin market cap right there. Those smart contract platforms.
No Canton? You're not going to get any Canton or Arrow? Or
I would love to buy Canton, and it's definitely going to be on my list. But the problem for me with CC is that it remains very inflationary. And so I need to see that BME make a move up towards 1.0 for me to buy the thing. So
I can. That's valid. That's valid.
Yeah. So like, but when I take a look at the BME, as of right now today, Mike, it's sitting at 0.6679. 0.6679 is not 1.0 or above. So like, I need to see it. Yeah, super inflationary. As much as I love Canton, and I do, and I love what I see from the protocols that are being launched on Canton, because their tokenomics look amazing. Like, I don't think, like, bro, I haven't seen a protocol on Canton Network. I have not seen a protocol with bad tokenomics. Not yet, anyway.
And actually, I haven't. There's a bunch of them that don't even have a token.
And that's a good thing.
So a lot of value, a lot more value gets driven to the CC token. But again, it is still inflationary, and we are going to keep pointing that out as long as it's inflationary, because we like to paint the whole picture. As bullish as we are on Canton, we are going to point out the pros and the cons of every project that we cover here, because we're here to educate. We're not here to hype. We're not here to pump stuff. We're not here to, talk our bags. We're here to educate you.
And so here's another challenge for me with CC. I can't self-custody CC in a hardware wallet. The only hardware wallet that actually allows you to self-custody CC is CipherRock. And my experience with CipherRock and their team so far has been very poor, very poor.
Well,
so
I was talking.
Is important.
I was talking to Scott this morning, because he has the ear of a bunch of the lead people over there, and he said that he was working on helping you get that refund.
I mean, so far my responses from them have been, this is it. our team is still finalizing the internal clearance process for your
Well,
USDC transaction.
and
And it's like,
and
what?
I'll say this: we shouldn't need to have an insider to help you get a refund.
Like, dude,
You
we're
know,
talking about $90. Like, I don't
yeah,
understand the problem. It doesn't make any sense. And so, like, in crypto, when trust is lost, it's very difficult to get that back.
yeah.
And so, if I
So
can't even get a decent response about a $90 refund, how in the world am I supposed to trust that hardware wallet to store my CC? Right?
so
Difficult.
so David, Ginger Prince, one of our boys that always in the chat. What do y'all think is the best crypto to spot hold if I put $500 into it? Bitcoin, Ethereum, or Hype?
I would strike Hype from the list simply because I think that there is a lot of regulatory risk with that Clarity Act for Hype, for the Hype token. Now, a lot of people have been saying that they think KYC AML on Hyperliquid will be a huge net positive for Hype. And I could maybe see that argument, but I don't know. I think that there's a ton of regulatory risk. So for me, Hype is out. Now, for $500, what would I do with it? If Hype is out and I've got only two choices, Bitcoin or Ethereum, what do I do? Man, if you take a look at ETH BTC, you take a look at ETH in Bitcoin terms, that chart. And in fact, Mike, I can share that screen real quick if you want to take a look at that. So if we just go ahead and take a look at ETH BTC real quick, this is why I'm so bullish on Ethereum over the next, let's call it like 36 months. I'm bullish because of this pattern, this right triangle pattern with the all-time high up here at 0.1566. This right triangle, bullish, very bullish. And sitting at resistance. Let me grab my arrow tool so that we can just mark this. So ETH BTC sitting at a level of long-term resistance in Bitcoin terms. So remember, it's always important to not just take a look at the US dollar chart of whatever your asset is. You want to know how it's performing in dollars, of course, because that's the unit of account for the world. But if you're taking a look at digital assets, it's probably a good idea to price them in Bitcoin terms too. So when I take a look at ETH BTC and I see it getting rejected at resistance, how many tests of this level of resistance have we seen? Well, if we zoom out and we take a look at the anchor up here at 0.1566 back in 2017, that was the ICO boom. That's the anchor. We've got one test right there. And then we've got, you could call this maybe a test here. So one test, two tests, three tests. Once you get up to three tests of a level of either support or resistance, it becomes much more likely to break on the fourth test. And so what I think could happen here, and remember, I don't have a crystal ball, okay? But what I think could happen here with Ethereum in Bitcoin terms is I think it probably puts in another move to the downside. But then after that move to the downside completes and the Bitcoin bear market ends, I think that ETH, when it starts to rally along with Bitcoin during the start of the next bull, I think that ETH could actually massively outperform Bitcoin during the next bull. So ETH still has a higher level of volatility than does Bitcoin. So if this level of trendline resistance here breaks to the upside, then the first stop would be that 200-week moving average, which as of right now comes in at 0.04557. That's ETH in Bitcoin terms. So, I would not be surprised if this level of resistance breaks and then you see ETH massively outperform Bitcoin. And that's during the next bull. So we're talking about from October of this year until basically like Q4 of 2029. That's the next bull market phase. So I'm thinking to myself, oh man, I love me some Bitcoin. Don't get me wrong. But I do think that these smart contract platforms, Ethereum, Solana, Tron, Canton, I think that these smart contract platforms are going to perform extremely well because, as Tom Lee likes to say, the killer app is the stablecoin product. That is the killer app. And as U.S. Treasury Secretary Scott Bessent has been saying, he expects stablecoin market caps to expand by a 10-bagger, 10x, over the next 18 to 24 months. And for us to see multiple trillions of dollars in US dollar denominated stablecoins on these smart contract platforms literally within the next 2 years. So if I'm going to bet on anything, I'm definitely going to be betting on these stablecoin contract platforms like Ethereum, Solana, Tron, Canton. That's why they're at the very top of my list. So Bitcoin, of course, because I love the sovereignty of Bitcoin. Ethereum, of course, smart contract platform numero uno. Solana, of course, very, very fast smart contract platform. And you're seeing OUSD launch natively on there. Tron, because that's where all of the Southeast Asian and Latin American stuff. Yeah.
We've dedicated plenty of time to answer that question.
Cool. Yeah, man.
Let's jump back. I almost forgot what we were talking about.
What were we talking about?
I found my tab. It was the privacy. So they cover Zcash's quantum recoverable ironwood upgrade and the turnstile proving the counterfeit coins never moved. Hold on. They cover. Okay. Ethereum's sprawling privacy roadmap and the risk it arrives too late. Logo's MixNet built to protect validators from block relays, now censoring transactions, and why all three see Canton's private stablecoins as little more than a bank with extra steps. The fight over what actually counts as privacy on a blockchain is only getting started. So I would be interested to see, because I know with that upgrade on Zcash, supposedly it was going to reveal if there was counterfeit tokens that were minted. I never saw anything come out about it. Did you, David?
I didn't. And look, again, when trust is lost in crypto, good luck getting it back. Now that, there was the report of that bug apparently being in that orchard pool for 4 years before it was discovered by someone using Opus on Claude Code on a $20 a month plan. So the fact that that bug existed for so long, and also the fact that the developers, I want a third party audit, man. I can't trust the team's, audit of their own software. It's trust me, bro.
Yeah.
I'm sorry, I can't. It's verify, don't trust. That's my ethos in crypto. Verify, don't trust. So I need a third-party audit before I can trust Zcash.
Absolutely. And I'll be honest, I'm not going to touch Zcash. And not to say that you can't make money off of it. I mean, all of these projects that we talk about that don't have value capture, that that we're not buying, it doesn't mean you can't make money on them. I mean, there's all across crypto, there's always speculative pumps, and as long as there's volatility and volume, you can short-term trade it, longs and shorts and make money. There's plenty of ways that you can make money. Just because a token doesn't have value capture doesn't mean that it doesn't have value. It just means, for me, a long-term investor, that's my investment style. I'm looking for tokens that have value capture. I'm looking for projects that actually generate fees and revenue and that don't have to dump their token to pay for operations, to pay for development, to pay for marketing or whatever. I'm looking for, projects, ecosystems that are expanding and growing. They're onboarding new customers, new clients.
Canton.
That's the big one.
Yeah.
And there's a lot of really high market cap tokens that we talk about here that just don't fit that trifecta criteria that we focus on here. Earlier in the chat, somebody mentioned, our thoughts on Ondo. Ondo, the project, is doing great things in tokenization and RWAs. However,
again, the coin,
it's a governance token as of right now. Can that change? Yes. AVAX is making moves to make it more their token more utility based, to try to give it more value as far as value capture. Ondo could do the same thing. if you want to make a speculative play,
Wasn't there a
higher risk.
proposal, Mike, for Ondo to do that? But we ran through the deep dive research on Ondo a couple of weeks
Yeah.
ago. And it's like, okay, so isn't there an entity in the Cayman Islands that owns like the vast majority of the
Yes.
governance power? So
I believe it was like 46% or something like that.
I thought it was much higher than that. I thought it was much higher than that. Like
It might
60.
have been. I'm just going off memory.
I thought it was like 60+%, and maybe even more.
And
So-
you very well could be right. And
And
if
it's
that's
like-
and if that's the case, you know, if they're making all that money, why would they vote to share that with token holders?
Right. You really think that? And it's owned by like 6 wallets, right? Like there's a handful of wallets that own the majority of the voting power for the Ondo protocol. And those wallets, I think, are owned by some Cayman Islands firm. So it's like, okay, you've got a handful of dudes that own all the voting power. They're making a lot of money. You really think that they're going to allow a governance proposal to pass that tells them like that they make less? No way. Not a chance.
I don't see it happening. But
Me neither.
Moneymaker, yeah. No, there's plenty that other than, you know, ETH and BTC. You know, I like Canton, I like Hype, I like Arrow, I like Tron. You know, there's a bunch of tokens out there that I'd like, and all of them have different, you know, levels of risk. You know, Arrow is probably, you know, one of my riskier ones. I'm a bit of a degen. I like the tokenomics. It's made me a lot of money in the locks that I've had. But there's, you know, there's a lot to be discovered, we'll say, when it comes to the new token. You know, they're merging with Velodrome. We haven't seen all the details. We've seen some about the new tokenomics. We've seen some of the functionality, the UX UI on the new platform, you know, and some of the mechanics that are going to be involved with it, but not all. I think that the team could do a lot better job being transparent about those things. Overall, though, I am still bullish on Arrow.
Yeah, I mean, I think that there are good reasons to be bullish on Aerodrome. The Arrow coin, I think that we probably have more work to do on the Arrow coin once they decide to release the details of that upgrade. You know, because as of right now, I see, you know, the team at Aerodrome, I see them shit posting Uniswap, but I don't see them releasing any details of their upgrade. So, like, you know, when details on upgrade, bro? You know,
Yeah.
I'm looking forward to that. And so I see a comment in the chat from Moneymaker XRP, and I just want to clear the air real quick. So in no way, shape, or form did I say Canton no good or Hype no good. All I'm pointing out is I think Canton is amazing. And the protocols that I see launching on Canton, they look great. The tokenomics, as a rule, look really, really good. Haven't seen a protocol launching on Canton yet where the tokenomics don't look good. So that looks great. And then for Hyperliquid, I just wanted to point out that I think there's regulatory risk there. That's all. Just pointing out, you know, the facts as I see them.
It's not, facts aren't FUD.
No.
We point out facts here. You know, even if we're bullish on a project, we're going to be fully transparent if there's, you know, risks or downsides. Again, I'm bullish on everything on Canton that I've seen, but the token is still inflationary, and we have to put that we would be irresponsible to point that out if we're claiming to be educators here. We're not hype men for any project. You know, our whole brand is integrity. So yeah, you know, and with hype, if some sexy new protocol comes out and all of the liquidity moves to that one and the fees drop, you know, enough, then the hype token that's deflationary right now could flip inflationary.
I would certainly look for that, you know, and then for me, I need to be able to self-custody CC in a hardware wallet. I need to be able to do that. And I've got to make sure that the hardware wallet is trustworthy. You know, as we've seen with Cold Card, and, you know, now with that BitGo CEO putting 100 BTC in a wallet and goading Anthropic to hack it. Dude, if Anthropic is able to hack that wallet and steal those BTC, bro, Bitcoin would go to zero in less than an hour. But how likely is that? Like, I don't think that that's likely at all.
We'll see. We'll see.
Yeah.
Well, so SVJ, welcome to the channel. you were asking thoughts on Just or JST. It's one of the deep dives that we've done. If you want to go to the node.pro and the Intel library, our whole Intel library is free. So if you want to, check out the deep dive, then you can go in here. There's, video that you can watch that will give you, kind of the elevator pitch on it, both good and bad. And we focus on the tokenomics. We focus heavily on if it has, value capture and, things like that, the things that we focus on here. And the most important thing on all of our deep dives is in the source document. If you scroll to the very bottom, this is something that you don't see other people do, is we actually cite our sources. All the information that we use to build our deep dives, we tell you where we got it and we hyperlink it. So you can go through and you can fact check us. And we highly encourage people to do so. If we get something wrong, please let us know. We want to make sure we're giving out accurate information. I have challenged the XRP Army and Kita and Cardano and all of
Kita, project that will not be named. Stay away.
It's we've challenged everybody to, if we get something wrong, by all means, let us know. But we've yet to have anybody, other than call us names, we never had anybody actually, give us an example of what we got wrong and give, and cited a source that shows that we're wrong. So until then, I stand firmly behind, all our deep dive materials.
Me too. I mean, look, I would love, so the way that I operate and the way that we operate is we build a hypothesis, and then we look for information that runs contrary to that hypothesis. We try to disprove ourselves. Mm-hmm. And, look, if we're going to post pieces of deep dive research and people are going to use ad hominem attacks, to the man, just call us names and not actually provide any facts or evidence whatsoever, then you know what? We're probably right, Yeah. So, yeah.
All right. So let's share this really quick. I think this will be our last news article, but BNB. So Crypto Stevo pointed out, and yes, the BNB token, it does have great value capture. It's, I'm not super bullish on, BNB. I think that they've done quite a bit of what appears to be, shady things to manipulate the markets. What the founder did with FTX and Solana, what I think it could have been handled much differently. What happened on October 10th, a lot of very questionable things happened on, specifically on the BNB platform. And then now
on Binance, on the centralized exchange, Binance. Yeah.
And then now you have this. Iran linked Dubai exchange sent Binance $676 million, Reuters investigation finds. So blockchain analysts traced at least $4 billion through an unlicensed exchange that gave Iran's central bank and a 2,000 site gambling network access to global crypto markets. An unlicensed crypto exchange ran out of a Dubai office above a budget hotel has processed at least $4 billion since May of 2024 as the hub of an Iranian sanctions evasion operation, according to a Reuters investigation. At least 676 million of that allegedly reached Binance. The exchange Shellbit is Shellbit, like a shell company.
I know.
Is run by Iranian expatriate, that guy, and gave Iran's central bank an illegal gambling network and other sanctioned entities access to global crypto markets. Reuters reported, citing data from two crypto investigative firms and researcher Rich Sanders, Shellbit has no website, and the door at its registered address carries the sign of a watch trading company, also registered to that individual. So what it showed, they handled at least 125 million from the Central Bank of Iran, much of it directly, plus about 20 million from a suspected Iranian mining operation routed through an intermediary wallets. Its customers included Farsi language gambling network of more than 2,000 websites, one of which alone accounted for 130 million. The exchange also interacted with wallets Israel attributes to the Islamic Revolutionary Guard Corps, with no Bitex, the Iranian exchange that Washington sanctioned in June. Shellbit is an IRGC operation that's that's plain as day, Sanders said in remarks to Reuters. Reuters said it could not determine whether the guards directly controlled Shellbit or where most of the crypto ended up. Of the money that reached Binance, about 540 million moved after Dubai's Virtual Assets Regulatory Authority fined Shellbit in 2025. So this looks to be pretty well sourced. So feel free to dig deeper into it. But
I found a picture of the hotel, Mike.
Oh, did you? All
it
right,
looks like
on.
a dump, dude. It looks
All
like
right.
a dump.
Go ahead and share it.
Oh my goodness, here we go. This is oh, there we go. Here it is. So this is I don't think I can zoom in on it, but this is the hotel. So
nice.
right here, this is the place, man. On the first floor, this is the place where $4 billion funding the IRGC was flowing through to Binance. So not good.
So Dave, I mean, were you able to find any? I know there's a bunch of unlocks. Do you have any good places where people could go to track the unlocks that are happening this month? Because the title of our show today is basically $1.28 billion dump August token unlocks. Do you have a place that we could look really quick on that?
Sure. There are a couple of them. Let me stop that screen share. And there's one site. I'm just getting there's a couple of sites, but I'm going to get some links here from Gemini in a second. You've got Tokenomics. You've got DeFi Llama, of course. So Tokenomics was formerly at tokenunlocks.com. So I'm just sharing my screen here. We can take a look. Now, one of the biggest unlocks that just happens all the time is usually from Sui. Sui is still like a VC chain.
Yeah.
But if we just scroll down here, we can see these projects that have big token unlocks. So let's see here, upcoming value. We can actually sort by upcoming value. And it looks like we've got, let's see, MNT. So didn't this one like momentum, or was that movement? I don't recall. Okay. So these guys are still around. But this looks like it's going to be, where is the unlock here? Upcoming unlocks, 755K in 7 hours is going to unlock. So MMT, the MMT, yeah. So MMT, I don't think MMT is movement. MMT is momentum. So different.
Because Jeff is saying movement filed for bankruptcy.
Right, different protocol. But if we're taking a look at momentum, so here, yeah. So here's this is MMT token, and I mean, I don't know how to explain this pump, but the dump certainly makes sense. So if we zoom in on this, you can see there's a massive pump like 4 days ago, at the end of July, just a couple of days ago. Massive pump, huge topping tail, huge dump. And since we're going to get in 7 hours that unlock, I would expect that this thing breaks its 200-day moving average and moves sharply lower.
That's huge sell pressure. So Rain is another one. $660 million worth of the Rain token is set to unlock this month.
Oof, man. So it looks like Rain is about to make it rain on the VCs and dump on the holders.
It's going to, yeah. And then Pump has $187 million. and Canton. Again, we're all about facts and data here. Canton is still inflationary. It's set to unlock $73 million worth of Canton token because of its burn mint. That all of the validators, super validators, people that contribute to the network, they earn Canton. That's where the new minted Canton comes from, and that's why we lean so heavily on adoption, because that is how how the burn mechanism increases with the mechanics of Canton. And so that's why we're so excited when we see like these new projects like the DTCC soft launch, like Broadridge, in the repo markets, and all of these different organizations that launch validators and super validators because they have to lock large amounts of Canton token. Then that is what eventually we hope will make it to where there won't be token unlocks, or the burn will outpace the token unlocks.
So, Mike, there is a massive unlock cliff for pump in September of this year.
Oh, yeah.
Yeah, massive unlock cliff. Now, if we just take a look at, because we ran deep dive research on the pump tokenomics, the
Yes,
pump
we did.
protocol. Yeah, we did. And so if I just take a look at the pump token, the price performance of the token, and then we zoom out here a little ways, it's actually performed decently well since the end of June. If I just go ahead and grab a measurement tool, we're going to measure from June to, so it's double. It's put in 100% rally since the end of June here. If we just zoom in so we can all see this a little bit better. It's put in 100% rally, but the problem is if we hop on over here to DeFi Llama and we take a look at pump.fun, the protocol. So the pump protocol, man, generates a ton of free cash flow and revenue. I mean, look at the earnings. Like, this protocol prints money. The problem is that the value accrual mechanism to that pump token is not very good. It's like, what did the deep dive research that we produced reveal? It was like less than 10% accrues to the token, which
something
is
like that.
Yeah, it's not enough to overcome the inflationary mechanics of the token. So that means number go down over time. But yeah, man, the earnings, like if you just take a look at the income statement for pump.fun, it looks great. It looks great. And so that's why you see the pump token end up on all of those different lists of like different DeFi protocols that generate a ton of revenue, because it does. The problem is you've got to dig a little bit deeper than that. And you've got to figure out like, hey, okay, generates a ton of revenue. But if I'm holding the pump token, is there a legit value accrual mechanism to me, the token holder? Yes. And unfortunately for pump, there is not. So yeah, for the guys who built it, there is, but not for us.
And that's why it's so, the value accrual is so important. It's the same thing with Ondo. It's the same thing with Chainlink. It's the same thing with a lot of these projects that are doing great things. The company and the products and services that they offer, they're getting a lot of adoption. A lot of great things are happening. A lot of them are generating, decent revenue, if not great revenue. The problem is what does that mean for you, the token holder? Because these aren't stocks. These are not securities. They have no contractual obligation for that token to go up. They have no legal obligation for that token to go up. And a lot of them, they dump the token to fund operations to bootstrap their company. That's our major complaint about projects like XRP and a lot of these is it's basically the token that they use to pay for operations while they build their company, to acquire. It's a big part of how Ripple paid for Medico and all these other companies that they bought, because it's easier to acquire a company that has banking licenses and different jurisdictional licenses already in place than it is to go through the process of trying to get those, and a customer base and all of those different things. It's easier to just acquire a neatly packaged company. It's a smart move, and I'm very bullish on what Ripple is doing. I just don't see where the XRP token benefits directly from it, other than speculative pumps, of course.
Yeah. And, I've got Pump.fun, the protocol, brought up here on DeFi Llama. And look, this protocol generates a ton of revenue. But is that a good thing? Is that a good thing for crypto adoption to know that like the number one protocol on Solana is a meme coin launching protocol? Like, really? Is that a good thing?
I mean,
It's a casino.
Las Vegas is built on gambling. It's basically gambling. I mean, that's all it is.
Yeah.
Meme coin casino.
It's a meme coin casino. I would prefer there to be real value, not gambling value.
There's always going to be a place for gambling. It's not my thing, but there is plenty of people out there that love it, and there's nothing wrong.
I know.
With it. As long as you understand it's gambling, it's none of my business what you do with your money. But all we're trying to do here is educate you on what these projects are and fundamentally what they are. You need to decide for yourself, what level of risk you're willing to take. And, and we could be wrong. We don't have a crystal ball here. We are just looking at treating these assets like we would a traditional investment, like in a stock, in a company. We are looking at these projects on if they have real adoption and customers. We are looking at if those customers buy their product or service and generate fees and revenue. And if we, the token holder, have any direct connection to those fees and revenue, because otherwise you're holding a meme coin. If you buy a token, no matter how successful the company is, if there is no value capture for the token, you are holding a meme coin. You are hanging your hat on community, mind share, and hype. That is the only thing. That's the only value to that token if there isn't value capture. Is there value there? We've seen it multiple times in crypto. Yes, you can get speculative pumps, but you can also get massive, massive dumps.
So did you see what Crypto Stevo is saying in the chat here? He thinks the meme coins are a net positive for crypto. And I mean, hey, look, maybe they are. I don't think that they are, though.
I don't either.
Yeah. And I mean, look, I remember what the NFT craze was. I remember people spending 100 ETH to buy a picture of a rock,
People
hosted on AWS.
Millions of dollars on cartoon monkeys, and they're worth like 10 grand now.
And now I'm looking at, on the Robinhood chain, the biggest tokens on the Robinhood chain are memes, Cash Cat, Stonk Broker, Pipe Dog, What If, and then this one, Tendies. Dude, this is literally a picture of a chicken nugget. Okay, like, come on, bro. Like, what are you doing? Like, dude, we've seen this movie before. We know how this ends. A $13 million market cap for a meme coin that's a picture of a chicken tender. Like, come on, guys. Like, don't buy this. But then again, people make life-changing money with this stuff, but it's gambling. It's gambling.
The problem I have with it, but it's really true of all gambling, is for every person that is screaming from the rooftops on socials that they became a crypto millionaire off of some meme coin, there was tens of thousands, if not more, people that lost everything so that they could make that money. It's simple math. There's only
I love the pictures, though. I love the pictures.
If there's $100 million of liquidity, in a meme coin, that means that people deposited $100 million worth of actual money into it. And the people that got in first, the first people to get out and exit with that liquidity are the ones that win. If you got in first, it got, it exploded, and you went from $500 to $5 million, and you pull your $5 million. There's only
look at Ashenbrenner. Ashenbrenner with the tendies.
It's musical chairs.
It's
a game of musical chairs. When the music stops and the liquidity's gone, did you exit and take profits? Do you have a chair, or are you standing there looking at empty hands when all the liquidity's gone?
Yeah, see, there's what's his name again? Kronos Kronos eating the tendies. Yeah, man. I mean, look, this stuff is great. The culture is great in crypto. It's funny. I love it. But like, seeing on Solana that the top protocol by revenue is, if we just go ahead and let me grab on here that column. I'm looking for fees. Let's just go ahead and filter by 24-hour fees. The top protocol on Solana by fees just about every single day. If we just, it's not displaying properly. There we go. The top protocol by fees every day, man, is pump.fun. So it's like, all right, well, this is probably not sustainable long term. Let me put it that way. Because look, we saw what happened with the NFTs. We saw what happened in 2024 with the meme coin craze. There were a lot of memes that put in, 100 X's, like 100 baggers. There were even some 1,000 baggers, 10,000. Like we saw that a couple of times. Book of Meme is a great example of that. But dude, like, we need real value to be driven in crypto. It can't be just a casino where 99% of people go and lose money. That won't drive adoption long term, I don't think.
And in a lot of cases, it will drive people out of crypto, because they hear it's a scam, and it's their own fault. It's like they hear it's a scam, they come in, they invest in a meme coin, they lose their money, and then they say crypto's a scam, and they leave crypto. And it's just like, yeah, because you invested in a meme coin, you didn't invest in fundamentals, you didn't invest in a solid project, in the actual technology. You bought a lotto ticket and you lost. You bet on black and it hit red. You hit and you got 23. It's you know what I mean?
Yeah, it's such a shame. And look, I want adults to be able to make that decision for themselves. I want them to be able to make that choice and say, hey, you know what? I want to be able to gamble on this meme coin. But the problem is, you've got to understand that that's exactly what you're doing. You're gambling, right? You've got to be able to understand that. I think a lot of people think that maybe they're doing something more akin to investing when really they're gambling. So,
and that's all we're trying to do here. If we all have that itch that we like to scratch. I do it all the time. I do it. I'm in a freaking Canton Long right now, and that's my little form of gambling. And it's a way for me to get a little bit of extra exposure potentially to Canton. And that's how I scratch my itch. Some people, that throwing $50 into a meme coin, that's the way that, in the bear market when everything's boring, that's their way of scratching the itch, because you never know. You put $50 into some obscure meme coin and it can 500x or more, and you can make a shit ton of money. It just, as long as you understand that that's what you're doing, you're buying a lotto ticket.
So speaking of buying a lotto ticket, sometimes you buy an actual protocol and you misunderstand what it is that you're buying. You're actually buying a lotto ticket and you think you're buying a legit investment.
So our first deep dive, VeChain.
Yeah, VET. So this thing,
I am not affiliated. I do not condone nor support.
No way.
no way whatsoever.
So this is the VET token. VET token.
This is not my meme. This is not my meme.
Has nothing to do with Mike. Nothing to do with the Node.pro. This is just happens to be named VET. This is VeChain. Yes. Down an astonishing 98.50% from its all-time high, which it put in back in 2021. If we take a look at one other piece of data here over on Coin Market Cap, okay, VeChain. If you can believe it, Mike, VeChain is still in the top 100. It's number 82. Yeah, man.
Well, dude, that shows you overall, how hard this market has been hit.
It also tells you how much garbage there is in crypto still.
Yeah.
Like when you've got something like this still in the top 100, I mean, dude, this has a $400 million FDV. Like, how does that make any sense, man? So let's take a look at this. Let's learn a little bit here about VeChain.
Hey, you know what? And maybe this deep dive will educate me and you that maybe there's some value here. I don't know.
There could be. I know nothing about this. I know nothing about VeChain. So let's take a look at this.
I hate you. I hate you bad. He says he's going to make Mike coin on Pump Fun right now.
Oh my goodness! Watch him put in a 1,000 bagger on it. It'll be awesome.
Oh, I know, right?
So just
I want royalties. I want royalties. I want royalties.
Let's get some royalties off of that thing. So I just posted this in the community for anyone who wants to follow along with the deep dive research. This is in the Node.pro official community on our website. So if you want to follow along, totally free to join. In the Intel library, here is the deep dive piece of research on VeChain. I posted that to the source room. Let's go ahead and let's play this. Let's learn about VeChain. Oh, can you hear that, Mike?
No, I can't hear it.
Yeah. I thought so. Let me go ahead and fix that. I'm going to stop my screen share. Let me start this back over so that we can hear this piece of content. There we go. And let's get started. Whoop.
Still can't hear it.
VeChain Thor is one of the longest operating enterprise layer 1 smart contract platforms in the industry, initially launching in 2015. Over the course of 2025 and 2026, the network executed a multi-phase renaissance roadmap, completely rebuilding its consensus mechanisms, gas markets, and token emission models. Today, the network operates in a stark dichotomy. It features highly upgraded institutional-grade architecture, yet struggles with severely constrained on-chain activity. On one side of this divide is significant regulatory progress. The core white papers for the VeChain ecosystem tokens have achieved formal confirmation and listing on the European Securities and Markets Authority register, fully integrating the protocol into the strict MiCAR framework. But an examination of the macroeconomic data from mid-2026 reveals a localized economy that has not yet matched its institutional standing. This split dashboard illustrates the tension. While the overall network maintains a market capitalization of roughly $380 million, the internal ecosystem is contracting. DeFi total value locked dropped to $2.1 million, driven by a 57% collapse in daily active addresses.
Yeah. So that's the chain dying. That's chain death right there.
Understanding this requires looking at VeChain's dual token system. The protocol intentionally separates functions. The VeChain token, VET, acts as the value transfer and staking asset.
No association between us or VET and the VET token. Okay, just want to make that clear one more time.
VTHO acts as the consumable gas required to run smart contracts. By isolating the cost of using the infrastructure from the speculative price of the main token, VeChain makes enterprise adoption highly predictable. But this design introduces a massive analytical challenge regarding how the VET token actually captures value. For VET holders to capture real economic value, the network must cross a very specific mathematical threshold. The protocol has to transition from its current state of consensus-driven inflation into a state of usage-driven net deflation. Prior to the 2025 upgrades, VTHO generation was a static, passive property. Every single VET token in existence generated a fixed amount of VTHO every day, regardless of whether it was staked, active, or sitting dead in an abandoned wallet. This legacy model churned out roughly 13.67 billion VTHO across the network every single year. It created a structural oversupply that heavily outpaced actual enterprise demand. The VIP 254 protocol upgrade dismantled that system. It entirely decommissioned passive generation, meaning unstaked VET no longer produces any operational yield. This adjustment instantly neutralized a major source of token dilution. Millions of VET deposited on centralized spot exchanges or held in inactive self-custody stopped generating excess gas overnight. VTHO issuance is now managed entirely through Stargate, VeChain's delegated proof-of-stake platform. Generation is a dynamic block reward tied strictly to active participation in network consensus. This equation calculates the new post-upgrade issuance. The total annualized VTHO generation is now a mathematical function of the total quantity of VET locked across all validated Stargate staking pools. The critical component here is the inclusion of a square root function. Plotting this equation reveals sublinear emission scaling. The relationship between staked tokens and generated gas is no longer flat. As VET committed to network staking increases, the marginal rate of VTHO generated steadily decreases. Based on 2026 parameters, this dynamic model yields roughly 7.3 billion VTHO annually. Compared to the legacy model, this cuts total energy issuance by over 50%. Slashing structural supply expansion in half was the strict prerequisite for VeChain. A token cannot become deflationary until the inflation rate is mathematically contained. With the supply side constrained, the focus shifts to the demand side.
Right.
Value enters the network when enterprises consume VTHO gas to execute smart contracts and process data on-chain.
Right. But what institutions are going to use VeChain? Why use VeChain?
This flowchart maps the Galactica protocol upgrade, which adopted the Ethereum EIP 1559 gas pricing architecture. The engine splits every transaction fee into two distinct functional components. The first component is the base fee. This is the compulsory minimum gas required for transaction inclusion. In the current iteration of the network, 100% of the VTHO consumed as base fees is permanently burned on-chain. The second component is the priority fee, an optional tip the sender adds to ensure rapid execution. This bypasses the burn address entirely and routes directly to the specific validator node that confirmed the block. This dual pipe structure replaces the legacy setup, where 30% of all base fees were simply paid out to node operators and pushed right back into the circulating supply. The updated mechanism operates like a high-intensity industrial furnace. It takes the operational fuel required to process enterprise logic and completely destroys the raw material. Every base fee burned removes VTHO from circulation, systematically tightening the overall market liquidity available on secondary exchanges. By setting the base fee burn rate to 100%, the protocol established a direct, algorithmic relationship. Every incremental increase in enterprise processing volume forces a proportional, mathematically guaranteed destruction of the token supply.
Yeah, but in order for that to work, you need enterprise volume. Is there enterprise volume right now? I don't think that there is.
There is a widespread misconception regarding the yields generated in this system. The VTHO earned by staking VET through Stargate is frequently mischaracterized as a share of protocol revenue. It is not. It is an inflationary token emission designed to secure consensus.
So that's something that we see a lot in these EVM chain and SVM protocols. We see inflationary minting of tokens to secure a network or protocol. And that's something that we do not see on Canton Network. We don't see these types of inflationary protocol tokens on Canton.
This balance scale illustrates the true macroeconomic state of the dual token system. The net change to the VTHO supply is entirely dependent on total daily generation on the left minus total daily base fees burned on the right. Examining the hard data from 2026 clarifies the current position. Stargate staking produces roughly 20 million VTHO daily. Meanwhile, average transaction volumes sit at roughly 267,000 clauses per day, burning only a minor fraction of that new supply. Because daily issuance massively outweighs daily destruction, the scale tips heavily toward generation. The network operates in a state of strict net inflation.
Right.
True real yield only activates under one specific condition. The aggregate daily transaction volume must scale high enough that EIP 1559 base fee burns exceed the daily consensus emissions.
Well, obviously that's not the case right now because a lot of times, you guys, if you just take a look at the price of a token, you can get a sense into what the market thinks of that token's tokenomics. So right now, it doesn't look good for VET.
When that happens, the system becomes net deflationary.
But it's not
Scarcity
right now.
takes over, forcing enterprise users to purchase VTHO directly from open secondary markets or acquire VET to stake, transmitting upward pricing pressure to the underlying asset. Until transaction demand scales past that threshold, current stake and yields remain end-based, and holders receive an inflationary reward subject to constant sell-side pressure on the open market. Because the base layer is currently inflationary, VeChain deployed secondary ecosystems to artificially stimulate the non-financial gas consumption required to force a deflationary state. The primary engine for this is VeBetter DAO. It is a cross-chain sustainability application ecosystem that operates entirely autonomously from the core network gas mechanics, utilizing an X-to-earn model to incentivize consumer actions. Vaybetter DAO operates on its own dual token incentive structure. It uses B3TR as the primary reward asset and a non-transferable token called VOT3, which users mint to govern how the application ecosystem is funded. This decay graph maps the highly structured distribution cycle of B3TR. Starting with a base of 4 million tokens, emissions decay over 12 years. Each weekly release is routed primarily into two funnels: a 40% allocation directly to decentralized applications, and a 40% allocation to the VOT3 holders who actively participate in governance. Historically, X-to-earn models face severe vulnerabilities without tight verification. Users execute Sybil attacks and submit fraudulent claims to drain the reward pools, collapsing the token economy. Vaybetter DAO attempts to solve this by routing transaction validation through an artificial intelligence layer called Agent Suite, executing off-chain validation while publishing cryptographic proofs back to VeChain Thor. Take the ecosystem application Mugshot, for example. It uses machine vision algorithms to instantly verify a user's photograph of a reusable coffee cup before it authorizes the B3TR incentive drop on-chain. The AI layer processes physical inputs off-chain at high speed, mitigating fraudulent claims while ensuring a constant stream of transactions hits the base layer. Alongside these AI tools, the protocol is executing the Interstellar upgrade to achieve full Ethereum virtual machine compatibility. The goal is to onboard standard developer frameworks to build out local DeFi, reducing the ecosystem's dangerous 73.2% reliance on the single VED delegate protocol. Ultimately, both the Vaybetter DAO consumer incentives and the EVM tooling upgrades serve one singular economic purpose: driving consistent, reliable gas consumption down to the base layer. By 2026,
Hey, David, real quick.
Yep.
I don't know if it's your mic, but there's like a humming, and I can hear your breathing.
Want to breathe into the microphone a little bit more, Mike?
Yes. It's like an obscene phone call.
L1 platform. It possesses a highly efficient sublinear supply framework, paired directly with a mathematically enforced value destruction mechanism. From a strict protocol architecture standpoint, the tokenomic value capture engine is fully built, operational, and audited. The outstanding variable for the VET token is no longer technical design. It is pure institutional adoption. The network requires massive, mandated transaction volume, relying heavily on incoming regulatory catalysts like the European Union's digital product passport requirements to force enterprise onboarding. Returning to our balance scale, this is the final theoretical objective, the point where real-world adoption volume finally overtakes structural emission, and the EIP 1559 base fee volleys lock the protocol into true net deflation. VeChain's survival as a deflationary institutional asset relies entirely on whether these incoming regulatory catalysts can actually generate enough on-chain activity to consume 7.3 billion VTHO annually.
There's no way. And by the way, Mike, the humming that you're hearing, there's a bunch of road work. They're burying all of the power cables around here. So there's a big machine outside working right now. But if we take a look real quick, Mike, what you got there?
Oh yeah, basically, while it was going through that, I found a place to look at some stats on VeChain. So I mean, there's actually quite a bit of information here. I mean, we can look at the transactions, average fees, the clauses, fee delegation, DEX transactions, the amount of accounts, new addresses, unique addresses, all that sort of thing. How many VET holders there are, VTHO holders, the supply generated and burned. There's a lot of data here. If you want to go to vechainstats.com, anybody that's bullish on this token or curious about it, you can see a lot of, and this is what you want to be looking at if you're thinking about investing in these type of assets. Is this ecosystem growing, or is it shriveling and dying? Because looking at the price, you would think potentially it's dying off. Looking at some of the stats, I mean, it's not terrible. Looking at this one here, network utilization. So this orange line is the total gas limit. You can see that it dropped off quite a bit recently. Total gas used is the green, and the gas target is the blue line. Let's go to VET holders. So the VET token holders. It's the amount of holders is stayed pretty strong. According to this data. Not a huge.
So, Mike, something that I like to do whenever I'm taking a look at a new protocol or chain that maybe I'm not familiar with is I'll always hop on over to DeFi Llama and I'll take a look at the largest protocols by DeFi TVL. So over here on DeFi Llama, what I see is we've got just a handful of protocols, like literally 1, 2, 3, 4, 5, and then like the 6th and 7th, this has $2,000 in TVL. This one has $17,000 in TVL. This one has $47,000 in TVL.
Oh, and these are all protocols on VeChain?
Right, and they're VeChain native also. And the way that I know that is you can see here it says one chain. So if I'm looking at the VeChain chain over on,
looks like not a whole lot of interoperability because they're all just on VeChain.
There's nothing going on here, man. And then like this is a governance incentives protocol. Not quite sure what that means, but if I see governance incentives, I want to stay far
not
away.
A whole lot going on here in DeFi.
Right, on the VeChain protocol or the VeChain chain. So let's take a look at one of these. Here's Stargate. So apparently this is the largest protocol on VeChain by TVL. It says 4 million in TVL, but I don't know that we can really verify that. So let's take a look. Let's take a look at the website. So here is Stargate. So it says stake VET, delegate NFT, earn rewards. All righty. So I'm going to click.
Thanks.
Yeah, I know. I'm going to click start staking. And it's saying Hayabusa is here. So this is
an upgrade.
Yeah. So like this is what I'm presented with the moment that I land on this. And okay, so what am I looking at? Like, how do I make money from this? Like, if I'm retail, and I am, and I want to use this Stargate protocol, like one thing that I always look for is you've got to be instantly able to understand how to use a protocol. If you can't almost immediately figure out how to use the thing and figure out what it does, then you probably want to pass on it. So I'm just taking a look at this and I don't even know exactly what it is that I'm looking at, but if this is just like a staking protocol, and I mean, if it says full, okay, let's click on one that's full. If there's 18 hours left, okay, reliability, stake 600 million. I'm assuming this is 600 million tokens and not dollars. So, okay, let's take a look at this one. This one's open. So if I click on this, okay, so I can stake VET for 6%, but so what? The daily volatility of the token is probably greater than 6%. So if we take a look at VET USDT, and then I just measure what was the vol of the token like within the last 24 hours, I bet you this thing moved by more than 6% just in the last day or so. So, I mean, 2.5%. So, I mean, the volatility here is really high. I don't know why anyone would want to use this. And I think that that's what we're seeing, because when you pop back on over here to DeFi Llama and you take a look at the protocols, there are none. And the TVL in them is minimal. So yeah, I'm going to have to pass. So let's go ahead and take a look, Mike, back on over here in the Intel library. Let's take a look at the next protocol, which is Cosmos. So the Cosmos network, I'm going to post this to the source room for anyone who wants to follow along. There it is. Posted that right there in our free community to join, the node.pro Pro community source room. So back on over here, taking a look at Cosmos, what I want to do first here is I just want to take a look at the Cosmos ecosystem, because I think that they refer to this as like IBC. I'm pretty sure, like inter something or other Cosmos. I don't know. But this one was always a pain in the butt to figure out how to use, because every single one of these chains on Cosmos, on the Cosmos Hub, had its own gas token. And so you had to first, if you were going to bridge from chain to chain, these IBC chains, you would have to first bridge, like a gas token over, and then you would have to bridge the asset over. And there were a bazillion chains. Yeah. And so Crypto Steve-O, I agree, man. It was a huge pain. Now, Osmosis is a DEX on there that was actually pretty cool to use, but, like not better than the other protocols like on EVM. And if you take a look at the Cosmos Hub, there's no TVL there any longer. So yeah, the narrative in 2021 was interoperability, but if it's too difficult to use, then no one is going to use it. And then if we take a look at the Cosmos token, which I believe is Atom. I think that Atom is the Cosmos token, and this one briefly went to 0 on October 10th. I think that this one was literally at 0 on Binance on October 10th. So if I'm taking a look at the October 10th data, yeah, it went to 0. It went from like $4 to 0 on October 10th. Now it did recover, but dude, like that just tells you how illiquid this thing really is. So, and then if you zoom out here from a daily to a weekly and you take a look at Atom, what I see is that there's solid support at 0. Like this thing can go to 0, So let's go ahead and learn a little bit more about the Cosmos network in 2026. I'm going to go ahead and play this piece of deep dive research.
Examine the architecture of modern decentralized infrastructure. The Cosmos software development kit became the foundation for a massive web of interconnected blockchains. Today, the Cosmos SDK and its inter-blockchain communication protocol power more than 119 independent chains. Together, this ecosystem represents over $45 billion in cumulative market capitalization. This comparison illustrates.
Is that true? I don't know if that's still true.
I
think
don't know if
that
that's
may
still true either. I'm like trying to look up some information on it right now.
I think that may have been true, but I don't think that remains true.
A stark macroeconomic paradox. While the surrounding ecosystem captured $45 billion in value, the Cosmos Hub's native token, Atom, hovered around a $915 million market cap, ranking number 71 globally. The root of this disconnect lies in the protocol's original design. Atom was built as a security mechanism, relying on a monetary policy of continuous programmatic dilution to protect its consensus layer. The network systematically expanded its token supply to force users into bonding their assets to validators. If you simply held the token without staking, your ownership stake was perpetually reduced by this high inflation. To repair this, Cosmos Labs and the Interchain Foundation initiated a comprehensive overhaul slated for 2026. This multi-phase effort aims to transition Atom from a standalone governance token into a revenue-capturing interchain settlement asset.
We're seeing this, this is what a lot of projects are trying to do now. A lot of people give us crap about our focus on value capture, but it's a thing. If you watch, all the news outlets and, you listen to the institutions and, you listen to, the big investors, this is, value capture for the token is where their focus is. You see, and these projects understand that. They hear that because you're seeing AVAX, you're seeing Cosmos, you're seeing, a lot of these projects revamping their tokenomics to give the token value capture. This isn't just us that has been harping about this. These companies are looking at these tokens and these projects like they would a traditional brick and mortar business. Do you have customers? Are they paying real money for your goods and services? And if I buy your token, is there a real connection to those fees and revenue? We're not making this shit up. This is just what smart investors do. Watch an episode. I use the example all the time. Watch an episode of Shark Tank and watch. It's repetitive. Watch the questions that they ask. Every single person that comes up on that stage. How many customers have you gotten in the past year? What is your revenue that you've generated? What is your cost of operating and manufacturing, per unit? And, they get into all the fine details. And the whole time you see them scribbling on their little notepad. It's because they're doing the maths. And the maths is, if I'm giving you $500,000 for 20% of your company, then what is your company worth? Because I'm not going to give you $500,000 for a company that the total value is $100,000. It's just, that is the way that smart money invests. And that is what crypto is moving towards. And if you're not paying attention, you are going to end up standing up with no liquidity in your wallet, while everyone else that listened sat down before, when the music stopped.
100%, Mike. And so that's why we focus on the trifecta. So when you're analyzing these, digital assets, you need to see three things. Number one, there need to be real users and real user growth. That means product market fit. Number two, those users need to drive real revenues. And then the most important thing is that those revenues accrue to you, the token holder. And that mechanism needs to be legit. It needs to be solid. So you need revenues, you need users, and you need value accrual. That's the trifecta in a nutshell right there.
Translate to economic value unless a strict monetary policy physically connects the two. Before rewriting that monetary policy, developers needed to map the exact source of Atom's price suppression. Quantitative research firm Gauntlet ran an on-chain analysis to track exactly where the protocol's staking rewards were flowing. This emission flow model shows the legacy system releasing 30 million liquid Atom annually. Uncovering a structural flaw, Gauntlet tracked rewards bypassing restaking entirely, with 42.6% routing directly to centralized exchanges like Coinbase and Bybit within 7 days. Broad retail sentiment did not drive this sell pressure. It was highly concentrated. Just 44 whale addresses were responsible for 79% of the selling during event windows, generating over half of the network's total structural outflows. Governance decisions exacerbated this issue. The passage of Proposal 848, which aimed to cap inflation, triggered a 7-day sell-off that moved more liquid supply than the collapses of FTX and Terra combined. Issuing massive volumes of liquid rewards to secure a network is economically self-defeating if whales instantly convert those rewards into downward price pressure. The 2026 overhaul addresses.
Those that don't remember, on October 10th, one of the tokens that went to zero, and it showed some very serious issues with the Atom token, was the Atom token. It's it basically collapsed to zero. I mean, just one giant red candle. And I mean, David, do you want to kind of expound on why it is that it was able to that was able to happen?
No liquidity, fake market. Yeah, they went to zero. They recovered, but there were a bunch of tokens that it almost went to zero. There were several tokens that were like negative 90+% on October 10th. ETHFI is another one that was like negative 93% or something. So all that tells me is that there really wasn't any liquidity there in the first place. And so those markets, those tokens were likely propped up by centralized exchanges making a market for them. And the moment that those market makers stepped away, the real market took over and the tokens went to zero. So that's what I think anyway.
This by choking off the supply. The legacy inflation ban, which fluctuated between 7 and 10%, is compressed down to a variable 2 to 6% range. But simply cutting inflation is insufficient. The protocol must rewrite validator incentives to favor long-term network holding over immediate selling. This step chart outlines the new fixed-duration staking multipliers. A standard 21-day unbonding period earns the baseline 1.0x yield. Voluntarily locking tokens for 3 months increases that yield by 25%. A 6-month lock increases it by 50%. A 12-month fixed lock doubles a staker's relative share of native emissions and fee pools. Short-term mercenary capital is mathematically penalized by severe yield dilution. Parallel to retail time locks, Cosmos is introducing an institutional supply sink through its enterprise stack. Institutionals requiring dedicated compliance tooling and legal indemnification pay annual licensing fees. Their commercial agreements require them to physically lock between 25,000 and 500,000 ATOM per deployment. By combining retail time locks with institutional vault mandates, the protocol systematically restricts the liquid supply available to spot market sellers. Constricting the token supply solves the dilution problem, but if programmatic inflation drops, the protocol must replace that staking yield with real, external economic revenue. The primary technological driver.
So this is something that we see in protocol after protocol, Mike, is that these protocols mint an inflationary token in order to incentivize validators to secure the network. And so now what they're running into is these problems because you can't keep printing a token to incentivize validators to secure your network when there's no activity on the network. That eventually just runs that token into the ground. Exactly.
It's a death spiral.
And then your validators step away and then your network dies. Yeah. So yeah, we're seeing that over and over again.
For this shift is the deployment of the IBC v2 protocol specification, known as Eureka. Historically, the inter-blockchain communication protocol was restricted. It primarily operated within the silo of Tendermint-based chains because the classic IBC architecture required complex, multi-step connection handshakes that external networks struggled to support. The Eureka architecture decoupling transport layers replaces heavy handshakes with a single zero-knowledge payload. This pushes native cross-chain messaging into Ethereum and Solana, allowing the Cosmos Hub to capture state verification fees and funnel execution revenue into its treasury. Multi-chain transaction bundlers can utilize ATM as the underlying settlement asset, executing complex multi-hop network routes with a single gas payment. This implementation transforms ATM into a toll-collecting router for the broader crypto economy, moving the asset's utility beyond basic cross-chain messaging. With real fee revenue flowing into the protocol, the 2026 tokenomics model connects this income directly to token supply through a mechanism called dynamic programmatic issuance decay. The protocol is designed to automatically throttle down its own token printing as gross network fee revenues increase. This equation dictates maximum inflation decaying based on a fixed constant multiplied by verified annual network fee revenue. As IBC routing fees push gross revenue to $60 million, inflation drops. Processing $1 billion crashes token issuance to zero. Once that 0% issuance floor is reached, protocol-level fee burns take over. The hub stops printing 30 million new tokens every year and transitions into a net supply reduction of 1 to 2% annually. This exact mathematical equilibrium means Atom's future scarcity is directly subsidized by the continuous economic activity of external blockchains. The elegance of this emission decay formula is entirely dependent on the physical infrastructure's ability to process the transaction volume required to hit those revenue targets. Generating hundreds of millions in fee revenue requires enterprise-grade scaling. This means successfully deploying the block STM concurrent execution layer and the AVAX storage engine, aiming to sustain 5,000 to 10,000 transactions per second. However, the operational risk during this transition is high, starting with the extreme sensitivity of the governance process itself. Historical data shows that abrupt adjustments to the network's mathematical parameters risk triggering whale unstaking, capital flight, and volatile liquidation events on spot markets. There is also revenue instability tied to interchain security. If consumer chains renting the hub's validator set fail to generate user volume or are sunsetted, the multi-asset yield expected by atom stakers will contract. The Cosmos ecosystem is pivoting between two contrasting frameworks. The pre-2026 model relied on isolated security and infinite expansion. The post-2026 objective demands compressed supply, ZK-routed settlement, and a deflationary target. This strategic realignment strips away the reliance on circular inflation, directly targeting the structural vulnerabilities exposed by Gauntlet's empirical data. If the 2026 roadmap clears its governance and engineering hurdles, Atom will successfully re-engineer itself from a security mechanism into a yield-bearing reserve asset for the multi-chain ecosystem.
I mean, maybe.
Yeah, well, I would love to see it. I would love to see it. We don't want to see projects crash and fail, because
No,
for every crash
absolutely
and
not.
failed project, there's those of you out there that have invested in the token, believing that it was going to make you money and help you change your family's lives. So we take no pleasure in it, but that's why we're here. We're here to cut through the hype. We're here to cut through the FUD. We're here to just give you facts, data, information, so that if you choose, we're not here to influence. That's why we don't call ourselves influencers. We're not content creators. We're educators. We're here to find information, provide you with that information. You still need to do some due diligence. You still need to do some digging of your own. But if you choose to invest in these assets, at least you'll do it knowledgeable about what you're investing in. And that is our whole purpose for being here.
So take a look, Mike, over here on DeFi Llama. This is the Cosmos Hub. So that IBC, inter-blockchain, what was it again? What does it stand for? IBC? Whatever it was a huge pain in the butt to be able to use. Yeah. But what I see is a DeFi TVL going from 7 figures, $2 million, down to 120K. And it did put in a big move during this past bull, but it's given it all back. And then if we scroll down here and we take a look at the protocols, Stride, a liquid staking protocol, and then we take a look at Osmosis Hub. Injective is one of the chains on the Cosmos IBC. So if we take a look at the Injective chain, look, this still has some DeFi TVL. And Injective, a lot of people were bullish on this one because they wanted to be able to use this for RWAs, trade equities on here. So, Injective, not bad, but and I remember
we're just
Swap.
seeing adoption for that a lot of other places in a much bigger way.
Right. And so this was actually pretty cool. This Dojo swap. I think I still have positions on this thing from back in 2024, man, when it ran up after it launched. This was when Injective was super hot. Yeah. And so after Injective caught fire, then this Dojo swap DEX launched, and I had some positions on here. I think I still do have them on there, but it's given it all back. So this is what death looks like for a protocol, and very unlikely that these protocols are able to recover back to their old all-time highs. So here's Injective. This is one of those IBC chains. Now, if we bring it on over here to TradingView real quick, and then we type in INJ we can just go ahead and zoom out, and we can take a look at this and see what the performance of Injective has been over the last couple of years. So here's the weekly. Now, the interesting thing about Injective is that back in 2021, that all-time high at $25, Injective actually bested that high. It put in a higher high during the last bull. It got all the way up to like $52. So most altcoins or protocols or chains did not actually put in fresh all-time highs if they had already been through a cycle. So most protocols or chains, most altcoins especially, if they put in a high in 2021, they did not then go on to put in a fresh all-time high in 2024 or 2025. But Injective is an example of one that did. So that's kind of interesting. But take a look at that 200-week moving average. $13.20 right now, trading well. Injective is trading well below that 200-week moving average. So that is not bullish. And then if we zoom in to a daily, it's trading above its 200-day moving average. And notice it actually was able to bounce at that 200-day moving average. So that's not horrible. But I just don't see the reason to own this versus, owning Bitcoin or owning Ethereum or owning, maybe something other than, Injective or Atom that's actually solid. So what type of grade, Mike, would you give to both not Injective, but to Cosmos and VeChain? What grade are you thinking for these things?
I mean, there is a possibility that, Cosmos could still do something. I'll go with a C on Cosmos.
Okay.
VeChain, that's a rough one, man. And it sucks because, the token is VET, it's my token. I gotta go with D on VeChain.
I agree. So we reserve an F for, straight up scams.
Yeah. F, it's gotta be pretty bad to get an F.
Yeah. So I'm just going to give VeChain I agree with you. So a D for VeChain. And I agree with you on Cosmos also. I gave Cosmos a C just because that SDK is used a lot. The Cosmos SDK, a lot of projects do use that. So let's see here. We've got 4 minutes left, Mike, in the call today. If anyone got value from this, then, the best way to support us is simply to like, share, and subscribe on YouTube. Check us out on X, _network on X. That's the best way to support us, you guys. But if you want to hop on over to thenode.pro, this is our official website. Every Friday, we have an overview of all of the pieces of deep dive research that we produced earlier in the week. So this is the synthesis overview. So this is, one of our paid products. This is $10 a month. If you're interested in getting this delivered to your email address once a week, you'd be able to run through all of the pieces of deep dive research and analysis of all of them that we produce every single week. So that is definitely valuable for anyone who's interested. We also run premium live calls on Mondays, Wednesdays, and Fridays. Those live calls take place in the community. The community here is free to join. The premium live calls, of course, are premium. So you can see that right here. Today, our premium live calls at 5 p.m. Eastern. Wednesday, 5 p.m. Eastern. Friday, 5 p.m. Eastern. You can see the full schedule of all of our shows here. So Mondays, every day throughout the week, Monday through Friday at noon Eastern, 9 a.m. Pacific, we run our daily Node main show. And then on Mondays, Wednesdays, and Fridays, we've got the Source Room Premium Live Call. On Tuesdays and Fridays, we do Crypto Trenches. I've got to go ahead and rename that show. What do we do on Crypto Trenches? Mike, how would you describe that one?
So Crypto Trenches is where we get down in the trenches and do battle. That's where we try to sniff out good content creators, people that genuinely are trying to educate people, and then just filter out the ones that are just plain shillers and the ones that are just looking to pump their bags, or they potentially are getting paid. So really it's just we're trying to get out there and basically fact checking. We go through, we find videos, we find posts, and we fact check them, and we do it on ourselves as well. If we put out information that was inaccurate, that's where we put it out. And we just want to make sure that all of you out there are getting the best information possible, so that, again, if you choose to invest in these assets, at least you're doing it fully knowledgeable about what you're investing in.
100%, man. And again, the best way to support us, like, share, or subscribe on YouTube. And that's all I got for today, Mike.
Absolutely. So tomorrow, join us tomorrow. David will be interviewing Alpin's CEO, Akash. This is a project that is on Canton Network. It will be during our live show during this time slot. And again, This Thursday will be our first show. Myself and David, we will be hosting a Spaces. We are the official hosts for Canton News and the Canton Army for their Spaces, and we will be interviewing Cashin, which is also a project on Canton. So can't help it. It's, most of these solid projects that we're seeing are being launched on Canton, and many of them, again, they don't have tokens. So and we're not paid by any of these organizations. This is going to be, as always, our true and honest, opinion on these projects, and we aren't going to pull punches. We let everyone know that we're not looking for a gotcha moment. We're not looking for anything like that, but we are going to ask real questions. These aren't paid fluff pieces. These aren't incentivized in any way. We will not compromise our integrity in that way. We want to stay objective. So I just want to make sure people understand that. Just because that we're hosting these doesn't mean that that these are paid advertisements or anything like that.
No, sir. And I'm looking forward to it. So it's going to be a great call tomorrow with Akash from Alpend. And then on Thursday, we're going to be taking a look at Cashin protocol, and we're going to be interviewing and the Canton Army X Spaces. It's going to be a great call. Looking forward to that. I think with Luke and Henry. So
yes,
that'll be cool.
Yeah, that is correct.
Awesome.
So on the way out, looks like Crypto Stevo sharing a little bit of alpha. So breaking, BlackRock files with the SEC to issue tokenized fund shares on Solana. BlackRock expanded its cash management strategy with the launch of a BlackRock daily reinvestment stablecoin reserve. Two major tokenomics changes up for vote on Solana too. Interesting.
Yes. And I posted about that in our community earlier today.
There you go.
There you
go. All right. Well, we thank you all. And if you could, please, on the way out, smash the like if you found anything here valuable or entertaining. If you could, give us a subscribe and share us out, because, again, we aren't paid to talk about anything that we do here on the show. We pay out of pocket for all this. And all we're genuinely trying to do is give people a safe place to learn about crypto and DeFi and not have to go through that gauntlet that many of us had to go through of shills and, paid, people that are paid to talk about projects. So thanks again. Till next time, Veteran Crypto out.
Peace.